Alright, let's get into it. You've probably heard a lot of complicated financial terms thrown around, and most of them are designed to be confusing. But every once in a while there's a rule that's actually designed to save you a ton of money. It's called a 1035 exchange. So what is it? Put simply, it's a provision in the IRS tax code that lets you swap one old, crusty insurance policy for a newer, better one, without having to pay any income tax on the gains you've built up. Think of it like trading in your old car for a new one at the dealership. Instead of selling the old car, paying taxes on the profit, and then buying a new one, you just roll the value over directly. It's that simple. Now, why does this even exist? The government actually wants to encourage people to maintain their life insurance and annuity contracts. They recognize that your financial needs can change dramatically over time. So, Section 1035 of the Internal Revenue Code was created to give you a tax-free way to upgrade your financial products. It's a way to keep your coverage relevant without the IRS taking a massive cut of your investment growth. Imagine you bought a cash value life insurance policy 10 years ago. Over that decade, you've paid your premiums, and the policy has grown in value. Let's say you put in $50,000, and it's now worth $70,000. That's a $20,000 gain. If you were to just surrender the policy and take the cash, you'd owe income tax on that $20,000 gain. Depending on your tax bracket, that could be thousands of dollars gone just like that. But with a 1035 exchange, you can move that entire $70,000 into a new, better performing policy, and you won't pay a single cent in taxes on that gain. You get to keep your money working for you. So the core concept here is deferring taxes. You aren't avoiding them forever, but you are kicking the can way down the road, allowing your entire investment to continue growing without being chipped away by a tax bill. This is a massive advantage. It means you can switch from a policy with high fees, terrible returns, to one with lower fees and better investment options, all while keeping your principal and your gains intact. It's a powerful tool that, when used correctly, can literally add thousands or even tens of thousands of dollars to your net worth over the long term. It's all about being strategic and not giving away your hard-earned money unnecessarily. So, who gets access to this incredible money-saving hack? It's not for everyone, and the IRS has some very specific rules about what qualifies. This isn't for your stocks or your real estate. A 1035 exchange is exclusively for certain types of insurance and annuity contracts. You can exchange a life insurance policy for another life insurance policy. You can exchange a life insurance policy for an endowment contract. You can exchange a life insurance policy for a non-qualified annuity. You can also exchange a non-qualified annuity for another non-qualified annuity. The key is that you are swapping like-kind products, at least in the eyes of the IRS. The rules are pretty strict about what you can and can't do. For example, you can't exchange an annuity contract for a life insurance policy. That's a big no-no. Annuity payouts are generally taxed, while life insurance death benefits are typically passed on to beneficiaries tax-free. The IRS isn't going to let you convert a taxable asset into a non-taxable one that easily. It would be like trying to trade your Honda Civic for a private jet and expecting the dealership to say yes. The exchange has to be a lateral move or sometimes a step down in tax privilege, but never a step up. Beyond the products, the ownership of the policies has to be identical. The owner and the insured on the old policy must be the same as on the new policy. You can't use a 1035 exchange to transfer a policy from yourself to your child. If John Smith owns a policy on his own life, he can exchange it for a new policy where John Smith is still the owner and the insured. Any change in ownership would be seen as a taxable event, defeating the purpose. So, to be on the VIP list, you need to be an individual who currently owns a cash value life insurance policy, or an endowment contract, or a non-qualified annuity. You have to exchange it for a like-kind product and keep the exact same ownership structure. It's a tool for a specific job. Understanding eligibility is the first step. Let's be real, not all financial products are created equal. The whole life policy your parents' advisors sold you 20 years ago might have been okay back then, but today it's probably getting crushed by high fees and mediocre returns. One of the main reasons to consider a 1035 exchange is to get into a product with lower costs. Older policies often have massive administrative fees, high mortality and expense charges, commissions that eat away at your cash value. It's like trying to fill a bucket with a hole in it. A newer policy might have significantly lower fees, meaning more of your money actually goes toward building wealth. Another huge reason is performance. Your old policy might be stuck in an ultra-conservative investment option, barely keeping up with inflation. You're essentially losing purchasing power every year. A 1035 exchange can let you move into a modern variable annuity, or a variable universal life policy offering many investment choices, including index funds that track the S&P 500 that gives you the potential for much higher long-term returns. You're no longer in the slow lane, you can merge into the fast lane where real growth happens. Sometimes it's not about performance, it's about features. Newer policies might include riders or add-ons your old policy lacks. For example, a long-term care rider. It could let you use your death benefit to pay nursing home or home healthcare expenses while you're still alive. That protects your other assets from being depleted by big healthcare costs later. Your old policy is a flip phone, the new one is a smartphone with a dozen useful apps. Finally, your needs and goals change over time. Maybe you bought a policy focused solely on the death benefit, but now you want cash value for retirement. Or maybe you have an annuity and found another with better payout options, or a more attractive guaranteed income stream. A 1035 exchange gives you the flexibility to adapt. It lets you pivot without having to cash out, pay a huge tax bill, or start over from scratch. It's about keeping your financial products working for you as life evolves. Okay, so you've decided a 1035 exchange is the right move. How do you actually pull it off without messing it up? It's a process that requires precision, so you can't just wing it. The absolute most important rule is this: you must not take possession of the money. If the check from your old insurance company is made out to you, the exchange is blown. You will owe taxes. The money must be transferred directly from the old insurance company to the new insurance company. Never ever touch the money yourself. Step 1. Do your homework. Shop around and pick the new policy or annuity you want. Compare fees, investment options, surrender charges, death benefits, special features or riders. Talk to a trusted independent financial advisor. Get illustrations showing projected performance. Be 100% certain this is an improvement. Step 2. Start the application with the new insurer. Fill out the specific 1035 exchange paperwork. The form asks for your existing policy number and old company name. By signing, you authorize the new company to contact your old company and request a direct transfer. This step ensures funds move between institutions without touching your hands. Fill it out completely and accurately. Step 3. The insurers handle the transfer. The new company sends the request to your old company. The old company liquidates the old policy. The old company sends the full cash value directly to the new company. This can take several weeks. Be patient. After funds arrive, the new company issues your new policy. You'll receive confirmation and your new policy documents. Let's smash the like button for the #1 benefit tax deferral. This is the whole point. By executing a proper 1035 exchange, you avoid paying immediate income taxes on any gains your policy has accumulated. That $20,000 in growth remains in your account, working for you, instead of going to the IRS. $50,000 in growth remains in your account, working for you, instead of going to the IRS. Or even $100,000 in growth remains in your account, working for you, instead of going to the IRS. This allows your money to compound more powerfully over time. Every dollar you can shield from taxes is another dollar that can be invested to generate even more dollars. It's the closest thing to a financial superpower that most people will ever have access to. Benefit number 3 is accessing superior product features. The insurance industry is constantly innovating. Newer policies often come with better bells and whistles that can provide immense value. You might be able to switch to a policy with a higher death benefit for the same premium, giving your family more protection, or you could find an annuity with a guaranteed lifetime income rider that provides a higher payout than your old contract. You might even find a policy with more flexible loan provisions, allowing you to access your cash value more easily if you need it. You are essentially upgrading your financial technology. Finally, a 1035 exchange can be a strategic move to lower your overall risk. Your old variable annuity might be invested in overly aggressive funds that no longer match your risk tolerance as you approach retirement. Or, your old life insurance policy might be with a company that has a questionable financial strength rating. Move your money to a more stable insurance carrier, or reallocate your investments into more conservative options without triggering a taxable event. It's a way to de-risk your portfolio and ensure your money is safe, all while keeping the taxman at bay. Now, it's not all sunshine and rainbows. A 1035 exchange is a powerful tool, but if you use it incorrectly, you can get absolutely wrecked. The biggest pitfall is being sold a new product that isn't actually better than your old one. Some insurance agents or financial advisors are motivated by high commissions. They might encourage you to exchange your policy for a new one that benefits them more than it benefits you. This is called churning. The new policy might come with a whole new set of high fees, or a long surrender charge period that locks you in for years. Always get a second opinion. Another major red flag is the surrender charge period on your existing policy. Most policies and annuities have a period of several years, sometimes as long as 10 years, or 15 years. A 1035 exchange avoids income taxes, but it does not avoid surrender charges. If you exchange while still in the surrender period, the old company will deduct those charges from the cash value before sending the remainder to the new company. That can cause a significant loss of principal, so check your current contract carefully. Be aware a new surrender charge period starts with your new policy. When you move money into a new annuity or life insurance contract, the clock resets. You may enter a new 7-year surrender period, or a 10-year period, or even a 15-year period. That makes your money illiquid for a long time. If you might need access to that cash soon, starting a new long-term contract could be a terrible mistake. Be sure you're committing for the long haul, because getting out early will be very, very expensive. Lastly, there's the issue of your health. Exchanging an old life policy usually means medical underwriting again. If your health has declined, you might not qualify for the new policy, or your premiums could be substantially higher. Sometimes your old policy is the best deal because you're now a higher risk. Don't assume you'll be approved for a better policy. Underwriting can be a major hurdle. Let's dig a little deeper into the costs, because this is where people really get into trouble. The number one cost to be aware of is the surrender charge. A surrender charge is a percentage of your account value that the insurance company keeps if you leave early. It might start at 10% in year 1, then decline 1% each year until it reaches 0. Example: $100,000 annuity, 7% surrender charge. Old company sends $93,000 to the new company. You just lost $7,000. First action: call your current insurance company. Ask, what is my current surrender value? Ask, am I still in a surrender charge period? Get the exact date the surrender period ends. Often, wait until the surrender period is over. A few months of patience could save thousands. Don't let an eager salesperson pressure you with, the new product will make up the loss. That is almost never true. Run the numbers yourself. Scrutinize fees on the new policy. Ask for the fine print, not just the glossy brochure. Administrative fees, mortality and expense, M&E charges, fees for underlying investment funds, costs for riders. These fees can add 2%, 3% or more per year. They act as a major drag on performance. A high-fee product can negate the benefits of the exchange. Finally, be aware of your basis. Basis equals signed premiums you've paid into the contract. In a 1035 exchange, your basis transfers to the new policy. Important for taxes later. For example, you paid $50,000, it grew to $70,000. Basis equals $50,000. After the exchange, the new policy still has the $50,000 basis. That tells you which withdrawals are tax-free return of principal, and which are taxable gain. It's technical, but crucial for tax accounting. So when is the perfect time to pull the trigger on a 1035 exchange? There isn't one single answer, but there are several key life stages and financial situations where it becomes a brilliant move. Career change. Approaching retirement. Received inheritance. One of the most common scenarios is when you are approaching retirement. Your goals shift, from aggressive accumulation to capital preservation to income generation. You might have an old variable life insurance policy geared for growth, but now you need something more stable. Exchanging it for a modern annuity with a guaranteed lifetime income rider could create your own personal pension. Another great time, after a major market run-up. Your variable annuity or life policy may have big gains, which can mean a large unrealized tax liability. If you feel the market is overvalued, you may want to lock gains and go conservative. A 1035 exchange lets you do that. Move money from equity-based sub-accounts into a fixed account or into a product with principal protection, all without writing a big check to the IRS. A significant change in your personal life can also be a trigger. You've paid off your mortgage, your kids have finished college, your need for a massive death benefit may have dropped. You could exchange a high-premium life policy for a paid-up, smaller policy, or for an annuity focused on retirement income. Conversely, you've had another child, or you've taken on more debt. Then you might need more coverage. A 1035 exchange can help you move into a policy with a larger death benefit, provided you pass medical underwriting. Your policies should reflect your current reality. Review your policies every few years. Good financial hygiene. The insurance and annuity market is constantly changing. Products get better, fees come down, new features are introduced. If your policy is a dud, high fees, poor performance, shaky company rating, that's a perfect reason to start shopping. Don't let it sit and underperform out of inertia. A 1035 exchange is your ticket to a better product. Being proactive about finding that better product separates savvy investors from everyone else. Before you go, if you found this breakdown on 1035 exchanges helpful, make sure to give this video a thumbs up. It really helps the channel. If you want more smart strategies for your financial journey, hit that subscribe button and ring the bell so you never miss an update. We're dropping fresh tips every week to help you make the most of your money, avoid costly mistakes, take control of your financial future. Don't just watch, join our community of savvy planners right here on YouTube. Thanks for watching and see you in the next video.